Retailers exposed, using Trump's tariffs to justify price gouging. Retail giants are under fire for exploiting President Trump's tariffs as a smokescreen to justify skyrocketing prices, and it's time to set the record straight. But here's the shocking truth. Many of these price hikes have little to do with tariffs and everything to do with corporate greed. In recent weeks, major retailers like Walmart and Target have been quick to blame Trump's reinstated tariffs on Chinese imports for their rising prices, but a closer look reveals a more sinister motive. And this is the part most people miss. Tariffs are not the primary driver of these price increases. The Trump administration has been transparent about its tariff strategy, emphasizing that these measures are designed to level the playing field, boost domestic production, and counter unfair trade practices, particularly from China. Tariffs are a long-term investment in America's economic independence, focusing on critical sectors like technology and manufacturing. However, retailers are using this policy as a convenient excuse to pad their already substantial profit margins, which expanded significantly during the COVID-19 pandemic and never returned to pre-crisis levels. Here's where it gets controversial. A Federal Reserve report exposed that retailers are raising prices on products not affected by tariffs, misleading consumers into believing that these increases are solely due to trade policies. This exploitative tactic not only misrepresents the impact of tariffs, but also shifts the burden onto American families. Former Walmart CEO Bill Simon even admitted that the company could absorb tariff costs without passing them on to consumers, yet Walmart has continued to raise prices under the guise of tariff-related expenses. This pattern of deflection is not only dishonest but also harmful to public discourse. By blaming the Trump administration, corporations are diverting attention from their own profit-driven decisions, which prioritize shareholders over customers. But let's ask the tough question. Are retailers truly victims of Trump's trade policy, or are they opportunistically exploiting a free market economy while shifting blame? The reality is that these corporations have thrived due to decades of outsourcing to China, and now they are resisting accountability for the very environment they helped create. A recent poll by the Protecting America Initiative found that 52% of Americans agree with Trump. Retailers should bear the cost of tariffs rather than passing them on to consumers. Furthermore, voters are calling for government accountability measures to prevent artificial price hikes. Here's the bigger picture. By weaponizing tariffs as a political talking point, corporations are inadvertently playing into the hands of adversaries like China. This narrative distracts from China's unfair trade practices and pressures the U.S. to back down from its America First agenda. The Trump administration's tariff strategy is not radical, it's common sense, supported by millions who recognize the importance of made-in-America manufacturing for the nation's future. Retailers must stop hiding behind tariffs and start being transparent with consumers. If price increases are necessary, own them. But don't blame government policy when the data tells a different story. Instead of working against America's economic independence, corporations should embrace and support a made-in-America future. So, what do you think? Are retailers justified in their price hikes, or is this a clear case of corporate greed? Let's hear your thoughts in the comments. Investing in uncertain times. How CSHI can help you navigate inflation and tariffs. The core issue at hand is the growing uncertainty surrounding inflation trends and how investors can navigate this volatile environment while still aiming for steady income. But here's where it gets controversial. Many investors might overlook the importance of defensive strategies during times of economic unpredictability, risking significant losses if they don't adapt. And this is the part most people miss. Understanding how to balance risk and reward in a landscape shaped by unpredictable tariffs and inflation pressures. Recent data from June's Consumer Price Index, CPI, revealed a notable uptick in inflation, especially in sectors sensitive to tariffs. While consumers have shown surprising resilience, the future remains uncertain as to how tariff-driven inflation will evolve in the coming months. For investors seeking income streams that also serve as a hedge against risk, the NEOS Enhanced Income 1 to 3 Month T-Bill ETF, CSHI, presents an intriguing option. According to the Wall Street Journal, headline inflation in June increased by 2.7%, up from 2.4% in May, marking the largest jump since January. Meanwhile, core inflation, which excludes volatile energy and food prices, stood at 2.9% for the month. Although these figures largely met expectations, the rise in prices for goods affected by tariffs could be an early warning sign of inflationary pressures building up. In detail, prices for furniture, clothing, toys, and other goods saw significant increases, while car prices actually declined. Sarah House, a senior economist at Wells Fargo, suggested that consumers might have anticipated tariffs earlier this year, leading them to accelerate their purchases, essentially front-running the tariffs. Additionally, many companies stockpiled inventories ahead of tariff implementation, temporarily cushioning the impact. Consumer spending on travel-related expenses dropped notably in June, which could indicate weakening demand. On the producer side, the Producer Price Index, PPI, decreased slightly, rising 2.3% compared to May's 2.7%. The core PPI, which excludes food and energy, increased by just 2.6%, the smallest gain since July 2024, as reported by CNBC. All these inflation figures can be interpreted in multiple ways, depending on one's perspective on tariffs and inflation. For some, the data signals looming inflationary pressures. For others, it underscores the ongoing uncertainty about how tariffs will influence the broader economy, consumer behavior, and growth. The frequent and unpredictable changes in U.S. tariff rates this year only add to the environment of heightened risk and market volatility. So, how can investors protect themselves while still earning a reliable income? The answer lies in defensive, short-term bonds. These instruments typically carry lower risk compared to longer-term bonds, making them suitable for hedging against interest rate fluctuations and credit risks. One compelling option is the NEOS Enhanced Income 1 to 3 Month T-Bill ETF, CSHI. This actively managed fund aims to generate attractive monthly income through an options-based strategy. Its goal is to deliver returns 100 to 150 basis points above what 1 to 3 month treasuries offer. The fund invests primarily in 3-month treasuries and sells out-of-the-money S&P 500 index put spreads, which are rolled weekly to adapt to market volatility. It's important to note that the options used are not ETF options but are S&P 500 index options, which benefit from favorable tax treatment under IRS Section 1256. This means that at year-end, these options are treated as if they were sold at their fair market value, regardless of how long they were held, resulting in a blend of long-term and short-term capital gains taxed at 60% and 40%, respectively. This tax advantage can be a significant benefit for investors. Additionally, some distributions from CSHI qualify as a return of capital, meaning they are a return of part of the original investment rather than income or gains. This can help reduce the investor's tax burden and improve after-tax returns. The fund managers also actively seek tax loss harvesting opportunities throughout the year on the options, further enhancing tax efficiency. With an expense ratio of 0.38%, CSHI offers a relatively cost-effective way to pursue monthly income while maintaining a defensive posture in uncertain times. For those interested in more insights, analysis, and updates on tax-efficient income strategies, the Tax-Efficient Income Content Hub is a valuable resource to explore. Understanding inflation. Key points from June's report. Inflation is surging again this June, sparking fresh debates about whether tariffs are quietly reshaping America's economic landscape. While the 2.7% annual inflation rate might sound familiar, it's the highest since February and hints at a tug-of-war between President Donald Trump's trade policies and the Federal Reserve's cautious approach. But here's where it gets controversial. Are tariffs really to blame, or is this just the economy adjusting to other pressures? Let's unpack the numbers and the political firestorm brewing around them. The Bureau of Labor Statistics dropped its latest report Tuesday, revealing a 0.3% monthly rise in consumer prices. That bumps the year-over-year inflation rate to 2.7%, edging above the Fed's 2% target. Excluding volatile food and energy costs, core inflation climbed 0.2% in June, hitting a 2.9% annual pace. These figures align with economists' predictions, yet they've stirred controversy, especially since Trump has repeatedly claimed his tariffs aren't driving prices higher. And this is the part most people miss. While some categories like vehicle prices fell, new cars dropped 0.3%, used vehicles tumbled 0.7%, others like clothing and household goods spiked, likely due to imported tariffs. Apparel prices jumped 0.4%, and furnishings rose 1% for the month. It's a mixed bag that leaves analysts scratching their heads. Shelter costs, the largest contributor to the CPI surge, saw a modest 0.2% monthly gain but remain a dominant force, up 3.8% annually. Even as lodging away from home plummeted 2.9%, the BLS emphasized that housing still anchors inflation. Meanwhile, food and energy prices flipped directions. Energy rebounded 0.9% after May's dip, while food costs edged up 0.3%. Medical care and transportation services also nudged upward, adding to the complexity. Trump didn't hold back. On Truth Social, he declared, "A consumer price is low. Bring down the Fed rate, now." Iran later demanded a 3-point interest rate cut, claiming it would save $1 trillion annually. His critics argue this ignores the broader inflation picture, but his supporters see it as a fight against unnecessary financial burdens. The Fed, however, remains unmoved. Chair Jerome Powell and his team insist the economy is strong enough to weather current conditions, even as Trump calls for his resignation and vows to replace him in 2026. What's even more intriguing? Markets seem unfazed, with stock futures and Treasury yields showing little reaction despite the political theatrics. But let's address the elephant in the room. Could tariffs be playing a role in these price shifts? Dan North, an economist at Allianz Trade, admits it's tricky to isolate their impact. Massive tariff hikes should hit consumers eventually, he says, but this report doesn't show it yet. That ambiguity fuels the debate. Is the Fed right to wait and see, or is Trump's urgency justified? And what does this mean for everyday Americans facing higher prices on essentials like groceries and rent? As the Fed prepares for its July meeting, markets are betting on a pause before a small rate cut in September. Yet the real question lingers. Should the Fed act now to curb inflation, or trust that the economy will self-correct? We'd love to hear your take. Do you think tariffs are inflating prices, or is Trump's blame game missing the bigger picture? Share your thoughts in the comments below.